In today's video, I want to show you some of the techniques I teach in a different market than what I usually trade, for you to see how these techniques are universal, meaning that they can be applied in any market and in any time frame you want. That happens because they relate to the core fundamentals that are present in all markets. So it doesn't matter if you trade the euro-dollar 1-minute chart or the gold weekly chart. The techniques work in the exact same way because markets are fractal in nature, which means that they are self-similar and scalable. In other words, no matter the time horizon you choose to trade, the price patterns are exactly the same. The only thing that changes is the size of the patterns. With that said, I'm going to show a really simple trade idea in the 1-hour chart of the S&P 500. Notice that I have drawn two horizontal lines in very specific places in the chart. Both of these horizontal lines are capturing the outer frequencies of significant market lows, as we can see here. The thicker horizontal line represents the usual way in which traders draw a support line. You'll see the problem with that idea in just a second. Observe that price shot upwards from the lows out of which the horizontal lines are marked. As a result, price surpassed previous major highs and rendered the major low in question as a solid market extreme, or as a general area where buyers have proven their ability to bring the market up. Since the market has indeed a short-term memory, when price comes back to an area where either buyers or sellers have proven their ground, it tends to recall what happened and react. The degree of this reaction depends on other factors, of course, but the important thing is that we can watch what price does when it returns to these areas. Clearly, we can see that price returned to the area where the horizontal lines are, and this is where we must increase the attention to detail in the analysis. If you know nothing about fractal bars or frequency lines, when price is in this demand zone, it probably means nothing to you. However, if you add the different layers of analysis that these tools provide, the situation begins to look very interesting. Look how price stops between the two thinner frequency lines, but it doesn't quite reach the thicker support line. That happens because, in an uptrend, buyers tend to pick the market at progressively higher levels, otherwise there would not be a trend at all. In that way, normal support and resistance lines can be suboptimal. Notice also that the thinner frequency lines form a small zone to which price converts later. Look how the lower tails of the price bar spike this zone several times, but never close below them. That's an indication that the same buyers that generated the large movement upward are still sitting in the demand zone. There are other hidden clues in the chart that will also point to the same area. For example, if we take an Andrews pitchfork and place it on the major alternating highs and lows that precede the area we are analyzing, we will see that the lower line of the pitchfork catches the lower tails of those bars near the demand zone in a very suggestive way. In other words, according to the Andrews pitchfork, those lower tails that are sitting on the demand zone are also a market edge, meaning that it's a possible reversal area. Another not so obvious line that we can draw here is a frequency line with a mixture of real and abstract anchoring positions using the highs around the area that formed the demand zone in the first place. Notice that the extension of this line also catches the lower tails of those bars that return to the demand zone. An interesting thing to observe here also is that the lowest tail in those bars belongs to a hybrid bar, as it is taught in the price action trading volume 1. The hybrid bar in this case gives an indication that the movement has indeed terminated. In terms of entry, we could simply enter at the open of the bar next to the hybrid bar, or we can think about a more precise idea by looking at a yet third line in the chart, which connects the lows around the areas that created this demand zone in the first place. Notice that this line also catches those lower tails, and it could be used as a trigger after the hybrid bar. In this chart, it's kind of difficult to see because there are many lines already, but there is a moment where the lower line of the Andrews pitchfork correlates exactly with the upsloping line I just drew. And all of that happens within the narrow demand zone outlined by the two thin horizontal lines. In terms of stop loss, in this case the logical thing to do would be using a stop loss below the tail of the hybrid bar and a target 3 times as large to guarantee a nice risk-reward ratio that allows the equity to consistently grow in the long term. We can clearly see that this configuration would yield a 1 to 3 risk-reward trade without much problem. With an analysis like this, it's easy to see how there is more than what meets the eye in any chart and at any moment. If you want to learn these techniques and many others in greater detail, check out the courses I provide in the video description. You can go to my website fractalflowpro.com to check out the table of contents of each course and to see the testimonials from students who already use the techniques in their trading. For those of you curious about the institutional trading methods, I'm writing the books as quickly as possible, and I'm really happy with how it's turning out. I believe that the material will be mind-opening to a lot of people who are curious about the way institutional traders really act. There are many different robust and sophisticated strategies that the retail trader can also use. If you enjoy the videos I do, please help support the channel by clicking the like button, subscribing to the channel, activating the notifications, and leaving your feedback about this video below in the comment section. Thank you very much for watching, and I hope to see you in the next videos. Take care.